Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
We thank you for listening today. Remember, if you have any financial questions, that's why we developed this show. Call us at 972-715-2424. Again, 972-715-2424. Or you can always go to our website, ilovemyretirement.com. All right. Today, what's happening this week? The market's kind of going all over the place.
Yeah, you're going to talk about the market. I was going to talk about the NFL. And I'm wondering, since we're coming from the star, the Dallas Cowboys headquarters, if anyone's boycotting the show.
Yeah.
No?
Let's hope not.
I'm hoping not.
Because we would always stand for the national anthem, right?
No, seriously, on a note, to answer your question, the 10-year bond went up significantly this week. So all of our retirees are close. They're trying to save money and get some return without taking an enormous amount of risk. Has got a little relief there.
You've seen this thing's weird. The interest rates really haven't moved, but like a 10-year rate,
right?
Last few months, it'd go up to 3, down to 2, or down to 1.7, back up to 3, back up. It's all over the place.
Actually, what you see though on your investment hasn't changed that much. Is that what you're saying? I agree.
Yeah, but it's just bouncing between 2 and 3, and that's. I never thought I would say, hey, that's decent for a 10-year lockup.
Funny thing.
It's just the way things happen nowadays.
You know, all these. Just like politics, you know, all of the stock commentators and that whole industry that's built up around this and investing and all that. Just as soon as they talked about the 10-year bond yield has gone up significantly this week, the very next thing out of their mouth was, and the Fed's talking about whether they should reduce rates to keep inflation under control. So they sure don't want it to go up very much, do they?
I remember, for all you people out there, I've been doing this 30 years, so is Guy, and people always tell me, well, I'm waiting for those interest rates to come back. You know, when the CDs start paying 7-8%, that's when I know.
Yeah.
I go, you remember the government in the late 70s, early 80s, they basically said this is a free market. You're supposed to let interest rates go wherever they go. Because what high interest rates do is they cool down an overheated economy. And low interest rates speed it back up, right? But the collapse from, like, I think 81 was the last time we had those real high CD rates, was so bad. It took so long to recover. The Europeans always controlled their rates, and so we kind of copied them.
Follow that model.
So all of you people that think you're going to have 10% CDs, good luck, because the government won't let them ever get there.
Well, and the truth be known, too, I mean, obviously, if you can get 10% and you're retired, that's great. But it was cyclical, too. When it got to that point, I mean, they may have been offering a 15% rate, but you probably were in your 20s or 30s and didn't want to tie up your money for 30 years then because you didn't know where it was going to go. I mean, that big rate, that 7, 8, 10% rate has to hit right when you need it for it to be valuable for you to do it, because it won't be there long if they didn't control it. So they've taken the peaks and the valleys, or the volatility, or their effort to take the volatility out of the market.
Well, a lot of us, like I said, I still think of me back in the day, you know, even though I'm gotten older now, I still think of me back in the day. I remember I had that VA loan.
Yeah.
It was 8.5%. I had 2 different ones.
Probably a good rate at the time.
Oh,
right?
my gosh.
Yeah.
People bought that house with it. It's not like we got now where they're, bidding on houses like
they were assumable too, weren't they?
Yeah, they were
non-qualifying assumable.
Oh, yeah.
That's
all
right.
they had to do is
That's
sign the form. They're in, right?
Yeah.
And boy, both those houses sold within 2 days.
Yeah.
They said, we'll never have 8.5% interest rates ever. This is craziness. And now we know exactly what happened. It's not like Plano now, like your house. We got bidding wars because all the people moving in. This was just normal real estate. Takes 6 months to sell a house or whatever, and they'd sell immediately just because of that low rate.
Well, and I think those assumable notes too was a real premium, because you could get anyone could qualify for that.
I can't believe they let that go through. But
I wonder how many of those actually defaulted.
I'm sure
in the day,
a lot of them did.
right? Because the people that wanted those were people that needed them. It's kind of like putting your money into a high yield bond. There's a reason you're getting a high yield. There's a reason they're getting a non-qualified assumable loan.
Oh, no. I had a client tell me the other day that he found a 2.4% 5-year CD, which, by the way, the average in America is 0.8.
I hate to say it, but that ain't bad, right?
That ain't bad at all.
No.
But I go, well, it's an internet bank. He goes, no, it's not. And one of them was Goldman Sachs Bank. And I go,
got it.
That is an internet bank.
Got it.
just because it has a parent name to it, it's still an internet bank. There are no branches. You can't go down there and wring somebody's neck if they screw with your money.
That's right.
And I'm too old. Like I said, I get the paper every day. I have to touch the thing. And now everybody thinks I'm the only one in my neighborhood who gets it. The paper boy has to come to my neighborhood specifically just to bring me the paper.
That's
but
crazy.
I'm
right?
one of those guys, and I'm sure it's fine. It's FDIC insured, right?
Yeah.
But it scares me to death. No, there's nowhere I can go.
Can't
Nobody I can
knock
talk
on a
to.
door.
Nothing I can do with this internet CD. And there could be some deal where if you don't renew it within 36 hours of when it goes, it gives you another 5 years or something. There's something like that. They used to have some of them where you had to open a checking account. You got to do like 20 transactions a month, all this kind
Use
of
a
crap.
debit card, yeah, all that stuff.
So you got to be real careful because the big banks obviously don't want your business.
Well, for many reasons other than the low rates. When's the last time you've ever, and I try to use the ATM machine, and even for large deposits, if they're not automatically deposited, I'll go through the ATM and get a copy of the checks. But it's terrible. The last time I went, and it's a big bank, and I've been there since 90 or 91, one of the banks that I use, and there was one gal in there. I was going through the drive-thru. The same gal was operating or was working on a walk-in customer. When she got done, no hurry, she got up out of her seat, slowly slid her seat back in, shuffled some papers, and then casually walked over to the window where I've been waiting for 10 minutes to take my deposit so I could give them money. Come on.
Even I don't even blame the employees. They've cut them so much.
Absolutely.
Remember, in the old days, when you go to a drive-through line, there'd be like 10 lines with 10 tellers just for the drive-through.
That's right.
Right.
Absolutely.
Then you'd have 4 or 5 people in the inside line.
Yep.
Now you got 1 or 2, 3 people trying to do all of it.
The whole thing.
And you'll see, try to find a drive-through thing that half of them aren't closed. They only got 1 open.
That's
I mean,
right.
it's just, the banks have they have more profit margins than the highest in the history of banking, and they're still screwing you with it like that. It's like,
They're paying the least, and they're charging probably
That's
the disparity between what they're paying and what they're charging has got to be greater now than ever in history.
Oh, yeah. So just for you listeners that haven't listened to this show for 20 years,
Yeah, right.
they are part of my axis of evil.
I know where you're going.
Banks are part of my axis of evil. Airlines for charging you premium seat that has an inch less after they took 3 inches off the dang thing a year ago. Now to get an inch back, you got to pay a premium. It's ridiculous.
I missed that. Are they
Oh,
giving
no,
an inch
no,
back?
there's like premier seats now that are Coach Premier or something like that, and they're giving an inch back of the 3 inches they took the year before. Oh, they're a bunch of crooks. Yeah, remember they said
Try to use those free miles. Never mind.
That's right. The axis of evil, also my electric companies. Remember they said we only do it on natural gas. Our rates are tied to natural gas. They kept going up. They kept raising rates. Natural gas has been down for 10 years. They haven't lowered 1 rate.
No, they have not.
So it floats up when they want it to, but it never floats down. Is that what? Yes, axis of evil. Have I got all my axis of evil? That's
Well,
three.
I'm
Is there
getting
any more?
ready to go on politics if you don't if you don't get serious here.
All right. I was looking at this the other day. It was we've talked about this before. Investor behavior is the main cause of underperformance or of people running out of money, things like that. And that's why when somebody tells me the robo-advisors are going to take over, Vanguard, you can do everything in Vanguard. You can. I like Vanguard. I go, but until investor behavior, human behavior changes, in other words, our inability to take downturns, in other words, we'll do anything to avoid pain, right?
Yeah.
And if we got something that's making us happy, we'll stay with it forever. Even though like right now the market is double the value it's supposed to be. It doesn't matter. It's pleasure over here. I'm going to stay here. And as soon as it goes down, that's when you pull out. Nobody ever starts taking some off the top on the way up. Oh no. I'm not doing that. But that's what people do. So Dalbar is a company that studies investor behavior. It's their 24th year of putting out these surveys. Not surveys, but they study all the investor returns, all that kind of stuff. And so it just reinforces why we do what we do. Remember our philosophy? Whatever you have in bills coming in every month, at minimum your hard expenses. You have to pay for it with a guaranteed income stream. Now, if your Social Security covers that, if your Social Security and pension covers that, and or pension covers it, you're good.
Yeah, and if you've worked your whole life saving and organizing and tailoring your finances so that everything was paid off, your pension, like Victor said, your Social Security and all of that take care of it, then you've done a great job. But most people haven't.
No. If you have to take any money out of your 401ks, IRAs, or savings to live on every month, that is a bad thing. There is study after study that shows all the government agencies, the Department of Labor, Department of Treasury, Government Accountability Office, all agree to the same thing. You need to consider something to give you guaranteed income to at least cover your expenses. After that, what do they say? The same thing we've always said for 20 years, 30 years. Then you have the stock market is a good place because it's the only thing long term that's beating inflation. But it doesn't say everything goes in the stock market. That's why you've got some people that say what Fisher says, I'd rather have my mother go to hell or something than buy.
I'd rather burn in hell than invest in an
annuity. Another one here in Dallas said, if anybody mentions that word, they're immediately fired. I go, all of these people that tell you.
Same first name, Ken.
I know, but they don't have to, that you should never do that stuff. Every other they have no skin in the game at all. They don't care. They know if they talk good about the stock market, it's going to help that industry. Talk good about annuities, it's going to help that industry.
Someone who can be objective.
That's right. They all say the same thing. The only people that don't sell a competing product and say every single dime you have should be in a managed program or in the stock market, which is crazy.
The difference is these people that are managing and that are driving their income from managing your money or other people's money in the stock market spend millions, and I mean millions of dollars monthly to stay in front of you to tell you that's where you should put your money. Who was it that said, I think it was one of Hitler's underlings that said if you repeat a lie often enough, it becomes the truth. The problem is you get brainwashed, whether you realize it or not. You hear so much that all of the money has to be in the stock market. That's the only place you need to be. That's what you end up doing.
I mean, you've got Harvard, MIT, all the professors of all these places, plus Nobel Prize winners that all say the same thing. Almost everybody should do an annuity if their bills aren't covered. Annuity's not necessary, if not, unless you just want one as a fixed income alternative. Well, Jay worked pretty good for that,
and
too.
Along that same thought pattern, what happens? They get an article published or printed once, it comes out, and that's it. You don't hear it 5 times a day on every TV channel you're watching and every radio station you're listening for 4 months and just get beaten down with it. You just hear it once and it's gone. If you're reading the right periodicals to get it.
And a lot of that is, like I said, theoretically, long term, the stock market doesn't seem too bad. But the problem is we're humans. We're human beings. And this is why this latest study, again, reinforces why our plan, we think, is the most viable out there. But I'll give you an example. The average mutual fund investor has underperformed the stock market by like half. They've been getting about, even though it's because a lot of it's investor behavior. They're pulling out at the wrong time, pulling in at the wrong time. The average mutual fund people keep it for an average of 4 years when the market's doing well, less when it's not. And when do they sell it? When it's going down. When do they buy it? When it's going up.
Yep.
Instead of buying at the low, selling at the high, they're doing just the opposite because that's human nature.
Yep.
Do you want to jump in something that, look about it, take yourself back to 2009. Do you want to jump in a mutual fund that just lost 50%? I'm putting all my money in that sucker. Look how good it did. No. But what if it made 15% a year, 4 years in a row? That's the one that's showing it's a consistent winner.
I want to be a winner. I don't want to be a loser.
And you're doing exactly the opposite of what you should do because that's what human nature.
I don't know what the statistics are. I have not read them, but I would be willing to bet a lunch anyway that that 401ks do better because people have more of a tendency to put it in there and leave it as long as they're staying with the company and adding to it.
Even the bond index. So they've made about half of what the stock indexes make is what average investor makes when you account for fees and human behavior, all that kind of stuff. With bonds, the average bond index is made like 3.6 or something. The average person is like lost money. Yeah. So here's what it says, too, that no evidence has been found to link predictably poor investment recommendations to average investor performance. So what we'll say on the indexing side, which I love indexes, is, well, they were paying too many fees or getting bad advice from those brokers. They found no evidence of that. The analysis of underperformance shows that investor behavior is the number one cause, with fees being the second leading cause. And we've talked about that time and time again.
And a combination of those is fatal.
It's really bad.
Yeah.
You can't ever pay high fees. Some of these variable annuities out there have fees of 4 to 5% when you add all the riders and the fund charges together. So think about it. You got $1 million. You're going to pay somebody $50,000 a year. So it's got to make 5% to break even when we know the market made 4.06 the last 17 years.
It's a guaranteed loser, right?
The average investor made 2.
That's with dividends, by the way.
That's right. So you got to be very careful about that. There's nothing that investor behavior is number one. Fees are coming in number 2. But the gap between all these 20-year returns are just amazingly. Like I said, we always say the market made 4.06, but you can't buy the market without a fee. Even an index fund's got a little bit of a fee, right?
Yep.
And that it shows the average person doesn't hold something for 20 years to get the benefits of it. They hold things an average of 3 to 4 years. And if the market's going bad, that goes down. You'd think when the market's going anywhere for a long time, they held it long, like maybe the 90s never had a big down year but went up a lot.
Right.
They didn't hold it any more than that either. Because they're always looking for another better return.
Well, mine only made 7%, but this one over here
That's
made
right.
12.
My brother-in-law made twice with me. I'm obviously in the bad one.
That's right.
So they said acting in the investor's best interest should include affirmative practices to curb harmful behaviors. What was the other thing? Oh, it shows all the causes of poor performance. Now, one thing that we see is the Government Accountability Office had one thing. They said due to...
That's an oxymoron if I ever heard one. Government accountability. They actually have an office for government accountability. Nice.
I was talking about they said because of people's longevity going up, the loss of pension plans, they call them defined benefit plans,
right,
and the transition to defined contribution plans, which are 401ks.
Where you contribute to.
Right? And this is all contributing to why everybody should have another income stream that covers their expenses if the Social Security or pensions don't cover it. But it says the last thing is people don't have an understanding of how to manage assets to make them last throughout retirement. The same thing we've said on this show for 30 years. There's a difference between the accumulation phase of your life and the distribution phase. And that Government Accountability Report shows that people try to manage it the exact same way. Once you hit retirement, I think within 5 years to retirement.
Before, that's right.
Yeah. You have to change the way you invest. It doesn't matter like you don't understand, Victor. I've been doing this 30 years and I'm doing pretty good. Warren Buffett, I scoff at him. That's how good I am. It doesn't matter. You make one mistake in the distribution phase, you're eating cat food at 80. You got to be careful.
And you talk about human behavior and our habits, and we get entrenched and we have ruts and the emotion involved and the pain and pleasure and all of that stuff. Victor and I meet with lots of folks, and one of the things our financial analysis does that we offer to all our clients, we get your assets and your income and obviously ages and when you're going to retire and what pensions and what Social Security has and how much you need, your expenses, right? Once we got all the basic information, and we can run it, and it'll show you to the day pretty much with a little bit of inflation and a little stress test when you run out of money. If you don't have a lot saved up, it may be late 60s, early 70s. If you got a lot of cash, you may make it into your 90s. But then what we do is we make a couple of adjustments. We add fixed annuities, preferably with no fees if we can, and there are some of those critters, to use a Texas term, out there. And someone will sit down, and it'll be in black and white, taking care of your hard expenses, getting that handled so that you don't have to take money from an asset that fluctuates, the stock market, how much money you'll have left at what age. And with very few exceptions, taking care of the hard assets. You can see this in the analysis. It's black and white for Victor and I, or pragmatic. It's all numbers. It's black and white. It will increase inevitably. If you don't have enough money, it may add 10 years to your cash reserves, but also double what type of income you'll have monthly when the cash runs out. If you had enough money, it may add an extra $4 or $5 million to your bottom line. Obviously, this person had a lot of money. But either way, where my point is, and I'm circling around it, is it shows how much it'll help. People will see this, they'll look at it, and they'll agree with us. But some people, because they're so entrenched or they're emotional or it's so painful for them to do something different and break away from having everything in the market, they'll just stay where they are, and they'll go through, and they'll cause themselves grief in
Or
the
they'll
long
put
term.
themselves in something. They're afraid to make any of their money, like 10% of the money, illiquid for a period of time, even though they might have 80% of their money illiquid real estate.
That's right.
Because they know that. They're familiar with
That's
it.
right. That's right.
But the truth is, like, everybody wants the same thing. Remember when you were a kid? I'm going to save $1 million.
Yeah.
I'm going to put it in a CD.
Live off the interest.
I'm going to live off the interest.
That's right.
Everybody wants, okay, I want my principal in here. I want to live off the interest, good interest.
Not touch a principal.
That's right, not touch a principal. The problem is we got interest rates that are terrible. 5-year CDs average 0.84%. You can get internet banks about 2. Everybody else is at 1 or less. I go, so you got to save $1 million. You can't live on $10,000 a year.
Isn't that terrible?
Or
20.
But reallocating part of those funds to like an increasing income stream. I have found it dozens of times. I could show you examples of where we took 20% of a portfolio, and what happened is the person had $10 million. They had $10 million forever.
Yep.
So it was the same kind of accomplished the same goal that all of us originally want to do. Just live off the interest. We just know at these interest rates we've had for 15, 20 years, you can't live on that. But by reallocating, you can, and you can maintain your wealth, or at the very least, guarantee you'll never go broke. Call us at 972-715-2424. I'll be more than happy to go over this with you, go over your questions, and we can actually prepare this retirement stress test and analyzer. We throw in a Social Security optimizer, plus anything else. Our number 972-715-2424. Or you can always go to our website, ilovemyretirement.com. Let's talk a little bit about this. I don't know if you're interested in this kind of stuff, Guy, but I love this
What is
psychology stuff, right?
Lay it on me.
I liked it until my kid was trying to get a degree in it, and I was like, wait a minute, you can't get a job with that degree.
I thought it was liberal arts.
I think the psychology minor or major that's undergrad is one you can't get, and another one was like human relations or something.
Philosophy is always fun.
Philosophy, another one. All right. Well, the investor behavior that stifles people, it makes it where it's difficult. And then remember, they don't know how to manage the money in retirement. It's different than the way they should have managed it in the growth phase of their life. Well, number one, loss aversion. Nobody wants to take a loss, right?
No.
I'll tell you what, I've done the risk tolerance questionnaires for 30 years. And you'll find a person who goes, I'm pretty aggressive. I want aggressive returns. Well, what's the worst thing that happened to you? Well, it's taking a loss, of course. So wait, you want like double-digit returns, and you want to guarantee no losses. Exactly. Do you have that thing?
Or you get the opposite, right? What do you? How much? No risk at all.
Yeah.
What do you expect for returns? 8 or 9%.
Mm-hmm. You get that all the time. But narrow framing is another one. Making decisions without considering all the implications. Everybody does that. Mental accounting. This is another one. What they'll do is, I've seen people that know I've never made less than 10, 12% on my portfolio. I look at the portfolio, and they got 20% in stocks, making 10 or 12. 80% is in making 0.1 because they don't want to tie up their money. They're afraid they're going to go broke. I go, think about it. What if you tied up 30% of it? He goes, no, I just told you I'll never tie up anything. I go, it's to produce $100,000 a year. I would never do that, because I said, wait a minute, think about this. Tying it up, it's just a penalty. You can get out of it, right? You go get your money minus 2% or whatever. But you'd have to run through 70% of your money, because remember, you're not only putting 30% in something.
That's right.
With a 5-year term or whatever, right? 70% of your money.
In 5 years.
That's right. And you got 10% penalty-free withdrawals over here. So you have to spend. You've gone crazy. You've been retired for 2 years, and you've already gone through 70% of your funds.
And I got to tell you right now, if that's even a possibility, you really do need to tie up your money to prevent you from hurting yourself.
But that's what people don't realize. There's nothing wrong with tying up your money if you can get to it. You know, I don't like tying up my money I can't get to, though. Like some of these illiquid deals. I don't like where somebody's not going to get me out, like these private investments.
I'm thinking REITs and stuff where there's no market, you can't get out.
No, you can't. They all say you can get out. Some of them you can get out when the market's doing great. Try to sell one. It's just like selling real estate when the real estate market crashes. Go ahead and give it a try. That's why you'll see builders just giving the stuff away to get at least part of their building costs back.
Yep, get it
You
off
can't get rid of it.
loan.
When things are going great, you can always move stuff. When they're not, you can't. And for those of you old enough to know, everything goes down. Nothing ever goes up forever. So there's another one. Mental accounting is people will think they've made this amount of return, but when you take 80% of the money making 1 and 20% making 10, they're only making 1.2.
Yeah,
but
the
they
average,
think
that's
they've
right.
always made 10. I got a guy that came to me and says, I've never made 10. I always made 10. I go, okay, you had $1 million 20 years ago? He goes, yeah. You always made 10. I go, you should have like 12 million right now. No, that's not right. I go, you got 1.7. That's like 2% a year. No, that's not right. I go, what? Just put it in a calculator. But it's mental accounting.
That's right.
We say, no, our prowess is based on that. That's my reserve cash. Don't use that part. I said, what if you could get 4 or 5% on the whole thing? Wouldn't that be better? No, I don't. But that's what you got. All right. Diversification. They don't diversify enough. We know that. Anchoring. This is one thing a lot of people, they relate a familiar experience, even when it's inappropriate. No, you don't understand. My dad made all his money with ExxonMobil. So ExxonMobil is going to be the way I make it.
Always. That's
They
right.
always told him, don't put it all in one stock, but it made him a millionaire. See, they don't know what they're talking about. These so-called people just trying to get your fees. But that's what people do. Herding, Herding. Herding is, I'm going in when everybody's going in. This bull market started in 2009. How many people jumped in 2009? How about 2010? They started jumping in the last couple of years, just like they did in the 90s.
And I can tell you, if anyone and everyone wants to know when it's going to crash, do you want to know when? When the last person on the sidelines has been sitting there holding out forever, when that last person puts all of his retirement savings in the market so that we've got everybody completely in the market, that's when it goes down.
That's what the thing, we're not telling them. We love the stock market.
No, yeah.
We want you to invest in it.
Millions in the
You
stock
just-
market.
It's allocations, percentages of allocation. Remember, the Nobel Prize for Economics was won. 90% of your long-term return is not which investments you do. It's how your funds are allocated.
That's right.
And that won the Nobel Prize. So trust me. All right. Another one is regret. Treating errors of commission more seriously than errors of omission.
Didn't you
So-
date a girl once named Regret?
Yeah. I know that my name was Regret for a long time. Media response is another. This is investor behavior. Tendency to react to news without reasonable examination. Well, that everybody's guilty of that one.
Yep.
Right? Remember, we all see things through our own prism, our own filter, our own life experiences. That's why, I
There's nothing we can do about it.
No.
That's just the way it is.
That's why, like I said, I was trying to explain to my son. He's very liberal. I'm more conservative. And I said, it's just the lenses that you acquire. I've known people that are the most liberal people in the world that are the greatest people in the world. Same thing as the conservative. They're great people. There's nothing wrong with them. They seem to hate each other when you see in the media, but there's not. But people go with that.
But the bottom line is, and you're right, everyone has their own lens,
Right.
and there's not much you can do about it.
And the last thing when it comes to investor behavior is optimism. Believe it or not, with all the pessimistic stuff going on in the world right now, all the negative news, oh my gosh, people are normally optimistic. And so what they'll do is their belief is good things always happen to them and bad things happen to other people. And they will overly take too much risk even though they know. I have a person just the other day said, I'm very aggressive. And that's the reason I have this money. No matter what, I will never not be aggressive. I'm going to put 90% in stocks and probably nothing else forever.
And now
You can
aggressive,
do that, but you don't know.
aggressive can be getting in and out, so they're going to get out in time, although no one knows when in time is.
And that's why, like I said, all of this stuff, the Dalbar study on investor behavior, the GAO, the Department of Labor, the Department of the Treasury, the Nobel Prize for Economics, the different professors, all of that just reinforces what we do. Like I said, we believe you should have all your expenses paid for by an income stream, not from a dividend, because dividends aren't guaranteed. They can go away or go to nothing, but from something that gives you a check every month and guarantees it every month. And then you have the stock market to cover the rest. Well, that's our show, folks. I want to thank everybody for listening to the Common Sense Investing Show today. Remember, if you have any questions, don't hesitate to call our hotline, 972-715-2424. Again, 972-715-2424. Or you can always go to ilovemyretirement.com. I'm Victor McClure for Guy Allett. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.